We could kiss a handle of 1% on the Treasury market. It wouldn't take much to push us sub 2%. That's my gut feel on the bond market. Do you share that? Will we break the twos? The risk-reward in bonds, it's getting stretched. But what do you think on the risk-reward in the bonds? Do you think they will kiss the ones?
Well, look, I think it's certainly possible. I think a lot of that depends, unfortunately, on a situation that's inherently hard to predict, which is tension around North Korea. We have a potentially important anniversary coming up this weekend. I think if markets can get through that, they will feel better. I think as well, I think there is, in our view, rising odds that you will see a deal to at least temporarily push back and raise the debt ceiling, and that we'll see more details of that over the coming weeks. I think that would boost some sentiment in the market. But I think around the decline in treasuries, what's important is that the decline is coming in real rates. So from the perspective of how much does this affect equity valuations and how afraid should equity investors be, uncertainty is never good for markets. It's never good for valuations. But the fact that real interest rates are still falling, despite us nominally being in a hiking cycle, is, in our view, ultimately supportive of valuations. That if the real interest rate in the U.S. or globally is still not rising, that supports valuations that are historically above average, in our view.